Picture this. You bought shares of a major company exactly 1 year ago. Today, you open your brokerage account only to find that the stock price is exactly the same, down to the last cent. Most beginners would sigh in disappointment and say, "I just wasted my time. I didn't make a dime." But professional investors? They're likely grinning. Why? Because while the price chart was moving in a dull sideways trend, cold hard cash was steadily flowing into their accounts. Today, I'm going to show you how to put your capital to work at full throttle, even when the market is in deep hibernation. We'll break down the cash flow strategy and look at real numbers to see just how much you can squeeze out of giants like British American Tobacco. Stick around until the end, and you'll see why for the world's wealthiest investors, a rising stock price is often just a nice bonus, not the primary goal.
First, let's define what a dividend strategy actually is. Many people view dividends as a gift from a company. That's a mistake. Dividends are your legal share of the business's profits. As a co-owner, the company distributes a portion of its hard-earned cash to you, the shareholder. However, keep in mind, companies aren't legally required to pay dividends. It's a decision made by the board of directors. That's why our job is to find dividend aristocrats, or kings, corporations that haven't just paid, but have consistently increased their payouts for decades, regardless of global crises or inflation. You might ask, why don't these stocks grow as fast as the big tech giants? It's simple. These are often mature companies, known as value stocks. They don't need to build new factories every single day. They already dominate their respective markets. Instead of hoarding cash for risky R&D, they give it back to you. In recent years, amid global economic uncertainty, these companies have become the ultimate safe haven for savvy investors. Now, let's move to the most exciting part. What turns a regular income into a literal wealth machine? It's the magic of reinvestment. In the US, this is often referred to as a DRIP, a dividend reinvestment plan. The concept is straightforward. Instead of spending your dividends on a coffee or a new gadget, you automatically use that cash to buy more shares of the same company.
Look at the math. If your $100,000 portfolio yields 9%, you receive $9,000 in year one. But if you reinvest that, in year two, that 9% yield applies to $109,000. This is the essence of compound interest. According to the rule of 72, at a 9% return, your capital will double every 8 years, even if the stock price itself never rises by a single dollar. Over 20 years, your annual passive income could eventually exceed your original yearly salary. Dividends buy more shares, which pay more dividends. It's a snowball effect that over time becomes impossible to stop.
Let's look at the numbers using British American Tobacco, ticker BTI. As we calculated, with a $100,000 investment, your income would be roughly $9,000 a year. Why this sector? It's a business with inelastic demand. No matter what the economy does, people continue to use these products, allowing the business to maintain incredibly high margins. But taxes are a reality we must face. In the US, your rate depends on whether dividends are qualified. If they are, you pay a preferential rate, often 15%. For international investors, tax treaties often reduce the standard 30% withholding tax down to 15%. This leaves you with $7,650 in net profit. This is still significantly higher than yields from bonds or real estate, where net returns after maintenance, insurance, and taxes often struggle to cross the 4% mark.
However, I must give you a word of caution. There is a dangerous mistake that costs beginners millions: the yield trap. You might see a stock with a 20% or even 30% dividend yield and think, "I've hit the jackpot." But remember,
There's no such thing as a free lunch on Wall Street. Often, an extremely high yield occurs because the stock price has crashed due to a failing business. Always check the payout ratio, the percentage of earnings a company spends on dividends. If a company earns $1 per share but promises to pay out $1.20, it's a disaster waiting to happen. They are taking on debt just to pay shareholders. This house of cards will eventually collapse. The dividend will be cut, and you'll be left with a worthless piece of paper. A healthy payout ratio for most companies is between 40% and 70%. Anything over 90% is a major red flag.
So how do you find these hidden gems among thousands of listed companies? You don't need to be a math genius. You just need the right tools. First, use stock screeners like FinViz or Seeking Alpha. Set filters for dividend yield and payout ratio. Second, visit dividend.com. There, you can find lists of dividend aristocrats that have hiked payouts for over 25 consecutive years. Third, check the payout history. If a company maintained or grew its dividend during 2008 and 2020, that's a gold standard of quality. Our goal isn't just the highest yield today, but the most reliable yield for the next decade. Finally, let's talk about psychology. Many investors panic when they see red in their portfolio. But for a dividend investor, that's Black Friday. If a stock drops from $100 to $90, but the business is still generating strong profits, its yield for you has actually increased from 9% to 10%. You are buying a future cash flow at a discount. Market volatility is just noise. Dividends are reality.
To wrap it up, dividend investing is a marathon, not a sprint. Even if the chart looks like a flat line, your wealth grows through consistent payouts and automated reinvestment. Compound interest will do the heavy lifting, while you simply watch the cash hit your account. What dividend stocks are you holding? Are there aristocrats in your portfolio, or do you prefer higher risk yields? Let's discuss it in the comments. And don't forget to subscribe to learn how to build your wealth in 2026. See you in the next video.